Welcome to this week's Property Pulse Fireside Chat. Simon, what is today's topic?
There's been a lot of talk about new builds coming out of some of the tax changes that have been announced in the budget. And in particular, we're looking at whether this is setting investors up for a bit of a trap. Are investors being pushed towards new builds? Is that actually an opportunity? Is it a trap for the unwary? Just because policy might be pointing investors in a particular direction from a tax benefits point of view doesn't mean that every opportunity in that direction is going to be a good one. So we want to unpack that today and ask a simple question. Are new builds suddenly a smart opportunity because of the budget, or are investors being herded towards the wrong stock for the wrong reason?
Before we go on, I just want to raise a thought around the idea of the property entrepreneur versus the property investor. The property entrepreneur is the person who would do the add value projects. They are people who would be the developers, the renovators, those who actively invest, throw their money at properties for the purpose of making a profit or for creating a short-term growth-based win. Property investment is the idea of I throw my money at something, park it there, and then leave it there for a cash flow over a long period of time. Now, from an entrepreneurial perspective, from the property entrepreneur, you're on the side of those creating those new builds for people to buy into, which is a really powerful position to be in. If you're the investor, the one who likes to buy and hold residential properties, then you've got the question of, well, what am I buying? Because the policy is driving certain tax advantages in a particular direction. And this is the trap we're talking about. Invest for a policy or invest for the product, invest for the return. So, Simon, why are new builds getting the attention right now?
Yeah, so if we look at some of the key changes that have fallen out of the budget, one of them was negative gearing. So negative gearing effectively becoming unavailable for acquisitions of established properties beyond 1 July next year. In fact, anything that was bought after budget night this year no longer qualifies beyond July next year for negative gearing benefits. But new builds retain their negative gearing benefits. So if you buy a brand new property, something that's off the plan, something that is part of an infill development and a block of apartments, something like that, absolutely brand new, then if it produces a negative cash flow, so you've got more expenses on the property, including your interest bill, then you have income from that property and you own it in your own name, you can still offset that cash flow loss against your personal income tax at tax time, but only if it's a new build. So the new builds have policy support. They also give you the choice to still remain in the old capital gains tax regime, where you can get the 50% discount on your CGT bill at the end when you do sell. But again, only if it's a new build and you've owned it as a new build throughout. That's an interesting one because you actually have the choice. You don't have to do the 50% capital gains tax discount. You might choose to do the new inflation indexed capital gains tax at the minimum 30% tax rate on the inflation adjusted gain. You get the choice. We're still yet to see all the details around all of this, so we'll find out in due course exactly what it looks like. But the point here is that the government has made a policy decision to try and give investors more of an incentive to purchase new stock rather than to purchase established stock. And I guess the point there is to try and encourage some improvements in the housing supply. So the new builds still have the policy support. Now, what does that mean? Well, that means that a lot of investors are now starting to look harder at things like new apartments, new townhouses, house and land packages to buy, to hold as investments in order to get those tax benefits. And the developers, of course, are strongly starting to push the whole tax effective angle. And frankly, if you are a developer, then that's exactly what you should be doing in marketing to try and capture that market. So more power to you if you're one of the active investors, the developers in the community. You should be looking at your marketing in order to try and attract the investor towards your product as well and boost demand for your product. But that's what we're seeing. Now, what I am starting to notice out there, Brendan, is the spruikers are starting to jump on board with this as well. And it doesn't take long, does it, for once the the tax rules change for the spruikers to start really bringing the marketing engine to bear and going, well, you can get a subsidized purchase of this brand new house in this brand new estate and negatively gear it and get your CGT discounts. And isn't it a great deal for you as the investor to come and buy this property? But is it really? And that's sort of where we want to talk today.
Accountants will also be encouraging business owners or those high income earners for the purpose of offsetting their big incomes as employees for big salaries, offset that so they can get a better refund. And accountants are all about wearing a badge. Look what I'm able to do for you with tax. I've saved you this much money on doing my job really well, which is brilliant. Yeah, that's what it's all about. It's the accountants that will also now push those people into new builds. They will say, you know what, you could do property. It's a great way to store cash, no problem. It's a great way to invest. There will be growth over time and it'll support you in retirement. All those great messages. But if you want the incentives up front, if you want to be able to take advantage of all the opportunity for reducing your otherwise massive income and the tax debt or tax bill you have to pay, go into a new build. So the accountants will be supporting the developers and the spruikers by saying, yes, go and get something new. One of the things that's missing in this conversation, though, is quality. What is the right property to be buying? Anything will give you a tax benefit, but it's not anything will give you the outcome that you want.
Yeah. So when you say quality, we're not talking there about buying the highest end, most prestigious luxury apartment that you can possibly find with the Gaggenau appliances and everything plated in solid gold. What we're talking about there is the financial outcome, the quality of it as an investment is it going to deliver, because we've often said that tax treatment should never be the main reason why you buy something. It should be a bonus, an additional benefit, but not the reason to buy something. You're an investor. You're looking for a return on your investment. So is this going to give you that kind of return? I think when we talk quality, we're really talking about the quality of the asset, not the quality of the bricks and mortar and plastering and paint in the asset. And I think a tax benefit really doesn't fix a weak asset or a weak financial outcome. So let's unpack that a little bit. What are some of the potential downsides of buying new? And then let's think about the opportunities.
I'm driven to Cranbourne. Back in the 1980s, as I show my grey hair, Cranbourne was a new estate, greenfield estate. And it was put out there as being the best thing to be investing into. It's the place to go. It's the new area. If you're going to go invest there. If you're going to go buy there, live there, great. Prices remained flat for 10 to 12 years. So if you're looking for a return, it was a negative geared environment for a period of 10 to 12 years before there was any real financial value uplift there. And if you're looking for a 30-year objective, to lose 10, a third of your time in growth, is a massive price to pay. So care is really a requirement to making a good investment decision. Just throwing at an oversupplied area for the purpose of a tax benefit is going to potentially set you up for a fail, or at least not as big a gain.
You only get a negative gearing tax benefit if you're losing money. That's the whole point. You've actually lost money, so you're getting to offset some of that loss against your other income in the negative gearing model. So if that asset, taking your Cranbourne example, if that asset isn't appreciating substantially in value, then you're just paying for the privilege of losing money, aren't you? Just a phenomenal investing strategy. Why don't I just throw money away on top of money being lost? It just seems crazy to me that anyone would do that. And yet that is one of the core benefits that's spruiked by the spruikers and the accountants. I'm going to save you tax. Look how much better off you're going to be because you'll be paying less tax. Well, the only reason you're paying less tax is because you're out of pocket. That's the only reason.
You pay $1, I'll give you 32 cents back. Wonderful.
No, thank you.
It doesn't play out. It's not a smart move.
No, it only works in my mind if you have a longer term plan and you have reason to believe and expect from a data-driven point of view that your asset is going to outperform over time in terms of the capital growth to offset all the income losses along the way. That's the only reason it makes sense. And then the tax benefit is really just diluting that pain, easing that pain a little bit on the way through. But there's a couple of other issues in my mind when we bring this back to new builds specifically. When you buy new, you're buying a prepackaged solution, if you want to call it that. Someone's already done all the hard work in taking raw land, taking planning codes, taking designs and everything, and actually putting all that together to create the new house. And of course, they're going to be looking to make a profit in having put all that together. So they've already got a profit margin built in. So you are paying a premium compared to a similarly featured established house potentially in the same area. You're paying a premium for that new home. You might have less land content than the established homes because there might have been infills. So there's a whole lot of factors there. Brendan, you look like you've got something on your mind.
Yeah. You are paying a premium, and the point of interest, again, I'm going back to the greenfield estate model, because people will be driven to the greenfield estates. There's lots of choice. You can build the house you want. You can build the perfect home, the 4-2. It's a big house. It's on a small block, low maintenance. It's a great conversation for an investor who is, I don't want to do maintenance. I don't want to have to do this, and etc. Yeah. But the price that you pay for the greenfield estate is not determined by market forces. It's determined by the needs of the developer to walk away with a profit. As you said, there is a premium already built in. A market-driven value can really only go in the direction that the market drives it. And broadly speaking, that's up over a long period of time. But in an environment where you're paying a kind of false value, a sense of value based on what the profit wanted to, the developer wanted the profit to be in those areas, there is a risk that you overpay. And nobody will know that you're overpaying until enough time has passed after they're all sold to determine what market value actually is, to know that you've paid too much for it. So there is some real risk there. I'm not saying that everything's wrong in greenfield estates, but I am saying that there are risks that you need to be mindful of and go in not blind. Go in knowledgeable, go in wise around what you can expect.
Yeah, and especially when you've got things like the greenfields estates and I would put high-rise apartments in this category as well, you have a real high risk in terms of oversupply. There's a lot of very similar products there. It's very easy to create more of it. So you've got this injection of supply over time and potentially a high volume of supply. Well, as we know, price behavior in property all comes down to fundamentals, the economic fundamentals of supply versus demand. If you've got increasing supply and a steady level of demand, then prices will tend not to go up over time until that supply dwindles and gets to the point where the demand eclipses the supply. And then you might start to see that with price pressure. And we've seen this time and again over the years in things like greenfields estates. And as you said, the Cranbourne example, where prices can just stay fairly stagnant for an extended period of time. Now, if you're negatively geared, well, okay, at least you're getting something back at tax time, but you're still out of pocket without the value of the asset going up. And there's questions about whether that's a great strategy. The other thing that I would say is if you do end up with a lot more investors starting to gravitate towards new housing, then particularly in the areas where they're not so oversupplied, that competition could end up also putting some pressure on you as the investor when you're going in to buy it, and might force you to bid up your entry price. So it increases, again, the risk of potentially overpaying a little bit on the way in. And then finally, I think, Brendan, you come back to the point you made earlier. You're investing to make money, yeah, not to lose money or just to save tax. So if you're only investing as an investor to actually make money, if that's the whole purpose of your investing, then the deal that you buy still has to make a profit, not just give you some sort of tax outcome. And I think if the investment only makes sense, or if you think the investment only makes sense because of the tax treatment, I'd argue it probably doesn't make sense as an investment for an investor who's seeking a profit outcome.
That leads me to the idea of, well, sure, there's benefits in new builds from a tax advantage perspective. There are a lot of opportunities out there to buy new builds because there's a lot of new builds out there. I appreciate the desire of the government to push people towards new builds on account of we need more houses. We've got a shortage of supply. The point, though, for you right now as investors If you are a buy and hold investor looking for growth and growth areas, then you're more likely to have a win, I suggest, in infill estate. You're talking about someone's backyard or a redevelopment of from 1 into 3 or 1 into 4. You're going for where there are established areas that are still areas in high demand by owner occupiers. So there's an owner occupied desire to want to be there, but there are new builds coming onto the market as infill development. They would be where I'd encourage you to want to spend your energy, because you mitigate a lot of the risk there. Albeit a developer needs to make a profit on the build, but they are dictated their price by the market, not I'm making the market because I'm building the houses and you have to pay my price. Does that make sense? So there's a real difference in the weight and selection criteria. So that would be my encouragement. Go to established areas for those smaller developments.
Yeah, and I think before all the developers listening to this go, shut up, Brendan and Simon, stop telling investors don't buy these products. The strategy for you as the developer, again, is to focus on the areas where there's scarcity, not necessarily to try to compete with volume builders and the likes in greenfield estates, but to look in the established areas where you can get sites that you can infill, that you can offer a product that's inherently scarce back to the market. And then if you're the investor looking to buy something new, those are, again, the areas where you've got the scarcity advantage to help balance that supply demand equation more in your favor to get the growth over time. And so rather than buying into oversupply, you want to buy into scarcity, I think, is a key message here.
And that requires investigation into the suburbs. There will be some suburbs that will serve better than others. The fact that there might be an incentive for buyers to buy, or investors to buy new builds, so therefore the markets will improve for developers, doesn't mean everywhere is going to improve for developers. There is risk associated, again, wrong area, that sort of stuff. So spend time. The more sought after suburbs are the ones still that we would encourage you to invest your time and energy into. All right. So, Simon, if people were chasing new builds, we got 5 questions that we'd encourage people to ask. Run through those real quick.
Yeah. So before chasing a new build, you want to ask yourself, one, and I think this is a really important question, would I still want this property if the tax benefits disappeared? So if I couldn't get my negative gearing or my CGT advantages on this property, would I still want it? Is the only reason then, therefore, that I'm even looking at this for the tax benefits, or do I genuinely think it will deliver a financial outcome? Second question is there genuine demand for this sort of property in this location? So a lot of particularly novice investors make the mistake of just buying anything in a particular area, hoping it'll go up in value without recognizing that there's going to be a certain type of buyer that drives the market. So you want to understand where the demand's coming from. Number 3, is the supply limited? The scarcity aspect. Can a lot more very similar stock be built? So high rises can be built up, greenfields estates can be built out, or am I in an area where there's limited ability to do that, so the supply to stock remains limited? And number 4, who buys this from me later? Who am I actually going to sell this to? Because if you're an investor buying it for the tax benefits, bear in mind that the next investor, if you're looking for an investor to buy it off you, will not get those tax benefits. So your resale market is potentially more the owner occupier. You got to think about that.
And will they want it? 5.
And then finally, 5, what's my strategy? Does this actually help my strategy? Is it going to help me achieve my goals, or am I just reacting to these tax policies?
The potential opportunity. New builds in established areas with genuine scarcity, strong rental demand, owner-occupier desire, owner-occupier appeal. They are the areas we'd encourage you to go and invest your time and energy in, to either buy and hold, if you so wish, the new ones, or as a developer, to feed that market and to buy those properties that investors might want to buy from you that are still great products for owner-occupiers to buy from them later. Is it a trap, Simon?
It's a trap.
It's a trap. It's a
For
trap.
those who are the Star Wars aficionados out there, if you're buying generic stock in an area that has a huge amount of supply, that's the trap. And those areas are going to struggle to get you the good capital growth to offset your losses over time. So if you're buying into a high supply area, buying something that's just the same as every other house or unit in that area or in that building, Just because the brochure makes the tax treatment look attractive, you've fallen into the trap here. And that's what we'd encourage you to avoid. We're not saying don't buy new, are we, Brendan?
No.
That's not what we're saying. What we are saying is don't buy blind. Be intentional in your purchases. Know what the financial outcome is, the profit motive is for why you're buying this, and make sure that the deal fits that. That's what we're saying here.
If this is the first time you joined us in a Property Pulse, we hope you've enjoyed that immensely. We hope you've had a bit of a chuckle and a bit of a laugh, and we also hope that you've picked up some information that makes your investing decisions better. Look for upcoming events. We've got some events coming up out in the real world, not just online, coming up around the country. So my encouragement, get into the Real Estate Success community and look up upcoming events. For those people who are new to the community, can I encourage you to jump on the profile, fill out your details, your personal details? Why? That helps people to understand a little bit more about you and reach out and say hi with like-minded thoughts. Also, gives you the opportunity to then go and find others who might be thinking similarly to you, pursuing a similar strategy, and being open to share wisdom around how to do that successfully. We'll be back next week to keep the Property Pulse fireside chats going. Thanks, guys.
See you next Thursday.